Welcome back, Money Questers. What if you could transform your portfolio into a monthly income machine without buying real estate, owning dividend stocks, or waiting for bonds to mature? What if I told you there's an ETF strategy delivering jaw-dropping monthly income right now, so powerful it turns heads with an annual distribution rate approaching 74%? It's not what your financial advisor has likely ever recommended, but it's real. It's trading today, and it's part of a fast-growing family of aggressive income ETFs. If you're serious about generating cash flow, whether you have $100,000 to invest, or you're starting small with just $100 a week, this episode is for you. Before we get started, don't forget to subscribe to Money Quest Broker and tap the bell icon. We break down the most powerful and sometimes overlooked ways to make your money work harder for you. Let's jump in. This ETF is part of a suite launched by YieldMax. Their mission? Create high-yield options-based ETFs that pump out monthly income by selling call options on either a single stock or a group of stocks. The approach is simple in concept but sophisticated in execution. Here's the core strategy. The fund holds a diversified basket of U.S. stocks. It then sells covered call options on those holdings every month. What does that do? It generates premiums. Those premiums are then distributed to shareholders as cash flow. The trade-off? You get high income, but in exchange, you give up some or all of the potential upside if those stocks rally beyond the call strike price. It's like renting out your portfolio's growth potential for immediate cash. The fund we're talking about is part of the YieldMax family, and this one specifically is APLY, the YieldMax AAPL Option Income Strategy ETF. APLY holds shares of Apple Inc. and writes covered calls on those shares to generate monthly income. As of June 2025, its distribution rate is around 31.98% annualized, which translates to roughly $3,198 per $10,000 invested. Its 30-day SEC yield, reflecting underlying income excluding option premiums, stands at 3.42% as of May 31, 2025. In the most recent distribution on June 4, 2025, approximately 89.96% was classified as return of capital and 10.04% as ordinary income. So here's what that means in real dollars if you invested $100,000 today. The fund distributes about 31.98% annually, which is $31,980 in cash per year. That's approximately $2,665 per month. Since nearly 90% is return of capital, that money is coming from your own investment, not earnings. Imagine year one. You put in $100,000 and receive $31,980, but your NAV drops by that same amount, leaving about $71,230. Your next year's payout is then 31.98% of $71,230, or about $22,780. By year 3, the NAV falls again, and you're only collecting around $16,226. Let's extend this out. Year 1, $31,980 income, NAV drops to $71,230. Year 3, $16,226 income, NAV drops to $36,141. Year 5, $8,233 income, NAV drops to $18,337. Over 5 years, you've collected over $90,000 in distributions, but your remaining investment value has been reduced by more than 80%. That's the real cost of return of capital when NAV doesn't recover. Now let's shift to a more gradual strategy. What if you simply invest $100 per week? With consistent contributions of $5,200 per year, and assuming a blended 10% return over time, here's what your portfolio could look like. After 10 years, $82,875. After 20 years, $297,830. After 30 years, $855,369. That's the power of compound growth and income reinvestment, even with a high-income ETF like APLY. And unlike the lump sum model, dollar cost averaging helps you buy more shares when the price is lower, reducing the impact of NAV erosion over time. But remember, this ETF caps upside. When Apple stock surges, APLY won't fully benefit. Those gains are sold off via call options. Meanwhile, if Apple stock drops significantly, the ETF's NAV also declines. Though the call premiums can offer some buffer, they won't save you from major downturns. And don't forget taxes. Return of capital might sound appealing now. It's often not taxed until you sell, but it reduces your cost basis, which could mean a bigger capital gains bill later. So, is APLY a good fit? It depends. If you're seeking aggressive, consistent monthly income and you understand that your principal could shrink over time, this ETF might suit your needs. It's popular among income investors, retirees, and those supplementing other growth-oriented positions. But if your goal is long-term appreciation or NAV preservation, or if you can't stomach watching your investment slowly erode, you may want to explore dividend growth ETFs or total return strategies instead. No matter which path you choose, the key is alignment, matching the ETF strategy to your own timeline, cash flow needs, and risk tolerance. Have you used APLY or a similar covered call ETF? Let us know in the comments. Are you reinvesting or using it as an income engine? And if you found this breakdown helpful, subscribe to MoneyQuest Broker. We analyze complex strategies so you can make smarter moves with your money. Thanks for watching. Stay informed, stay strategic, and keep going on your money quest.